So it is 10:31. I guess we can start already now. I wanted to say good morning and thank you all for taking time from your busy schedule to join us today. We have 90 minutes planned. I think we might be able to do it a little bit shorter than that so that everybody can take an earlier lunch break. Since we are quite many participants, I would suggest that we take the questions at the end in a Q&A session. And if you have any immediate questions, you can of course write them in the chat, but otherwise, please save your questions for the last part, for the Q&A part, and then we take it there. Great. So, as a small introduction, we will today speak about tax transparency regimes, such as FATCA, CRS, mandatory disclosure rules, beneficial ownership registers, and economic substance requirements. We will also speak a little bit about what the future will hold. Of course, well, we don't have a crystal ball, but we see the trends and we will try to interpret them. This webinar will be rather generic or general. This means that we start broad with covering many topics, and then what we will do is, or the plan is, at least if you are interested in it, is that we will host more specific webinars in the future based on your feedback, based on your questions. So if we see that there's a particular interest in a specific regime to dig deeper, then we would like to start hosting webinars on a more general or more regular basis on more specific topics. So today with me, I have Lea Stühlinger, who is a part of my team, the Kendrick's regulatory team. I have Christian Luc, who is our CEO and also our FATCA responsible officer. Myself, last but not least, I would like to say, no. I'm Emily Mahler. I'm head of the Kendrick's regulatory team, and we deal with these matters on a daily basis for our clients. We have spent quite a lot of time and resources in building up our infrastructure, our knowledge library, and we would like to share some of our insights with you today. So when we look at the different regulatory reporting regimes, as we now call them, let's say we start with FATCA. The rules came into force in 2010, and the first reporting in 14. Then we had CRS, automatic exchange of information. Rules came into force in 2014. The first exchanges took place in 16 or in 17 for 16. Then we added on bioregister. Most notably, perhaps, the fourth AML directive was implemented in the EU, and all the EU jurisdictions were prompted to introduce bioregisters by the end of 17. Not everybody managed this, but at least they're on a good way if they haven't already finalized implementation. We also see bioregisters in many other countries in the world. So it's clear that this is the trend moving forward. All big, more or less, financial centers, offshore jurisdictions, etc. We have seen substance regulations coming up, especially that in no or low tax jurisdictions, typically offshore jurisdictions. We have the mandatory disclosure rules that came, or rather, the model mandatory disclosure rules by the OECD, they were published in 2018. Also, the EU implemented the DAC 6 directive in 18. So we see we're adding on layer by layer, or rather stripping off layer by layer, so the world becomes more transparent. Good. So I was thinking I will start with a brief FATCA CRS overview. These regimes are, of course, nothing new to most of you, so I will keep it quite short and sweet. I also decided, I might add, we decided to mix them so that we don't do, because of course they're quite similar to methodology. So we do a FATCA and CRS mix up, so you don't have to listen to the same content almost 2 times in a row. So if we start with the FATCA, it's a US regime, as you know, it's non-reciprocal, means that we provide information to the US and they do not give it back. It requires foreign financial institutions, banks, but also investment entities to provide information to the US authorities about US account holders, controlling persons, etc. And the US has entered into an intergovernmental agreement, IGA, with a large number of countries. The IGA system is quite ideal for countries to facilitate and make it easier for them to keep the costs down and easier to, let's say, interpret the rules. So I think at current, 113 jurisdictions have entered into an IGA with the US. We have the IGA 1 jurisdictions. That's the majority, I would say. Then we have a few IGA 2 jurisdictions. And here I would say the biggest difference is that the IGA 1 jurisdictions, here the foreign financial institutions report to the local authorities first, and then the local authorities will forward information to the US. And in the IGA 2 jurisdictions, the FFIs need to report directly to the IRS. The same would apply for FFIs in countries where there is no IGA, and also if one has optionally chosen to apply the US Treasury regulations. But yeah, again, the perk with the IGA is really that you have all of the rules collected in one neat set of 20 pages instead of hundreds of pages of US legislation. Moving on to the CRS, was developed in response to the G1020 request. It was approved by the OECD Council in 2014. And this regime, it draws heavily on FATCA. So you have noticed that there are very many similar definitions, etc. Here, the biggest difference is, of course, that it calls upon a large number of jurisdictions to collect information from their financial institutions and then exchange with its partner jurisdictions on an annual basis. So the idea is that it's a giving and taking. So you send and you receive, which is of course different than FATCA. Each participating jurisdiction must, of course, implement the rules in their national legislation, select a basis for the exchange, most of the time bilateral agreements between two countries, but for example, the EU countries, multilateral agreements. So you only need to enter into one agreement with all EU countries and not 27 different agreements. Of course, the jurisdictions or the authorities need to also put in place the necessary IT infrastructure and also have the resources. I mean, not only the IT resources, but the know-how to deal with the information received. Here we have prepared a world map over the CRS reporting jurisdictions, participating jurisdictions. And as you see, CRS is really spread all over the world. Previously, we talked about early adopters, the ones that started in changing in 17. Then we moved on to the late adopters, as we called them at that time, the 218 exchange. And then a large number of jurisdictions have basically been adding on with time. So there are each year now for 19, 20, 21, 22, 23, there are a couple or 5 new countries adding on. There's also a large number of jurisdictions in developing countries which have not been prompted to participate, but they have chosen to do so optionally, and they have not yet set a date for the exchange. And yeah, you see, so it's almost everywhere, except for the US and some other countries. So who are the key parties under FATCA or CRS? We have, of course, the financial institutions, or in FATCA language, the foreign financial institutions that may have a reporting obligation. A financial institution is, of course, a bank, like a depository or custodial institution. Can also be an insurance company. And in the fiduciary world, it's most importantly maybe investment entities. And the financial institutions have account holders, or in the FATCA world, US account holders that may be subject to reporting. This can be a bank account holder in the simple example, or somebody who owns equity or debt interests in an investment entity. Then we also have controlling persons or controlling US persons that also may be subject to reporting if they are, yeah, controlling person of a passive NFE. So these are the key participants. Of course, we have more person involved in this whole machinery. We also have the authorities, but this may be what you will see in your everyday life, right? How does it work? The methodology, I think this is nothing new to you, but let's take an example. I live in Switzerland, but I come from Sweden and I still have a Swedish bank account. So let's say that my Swedish bank asks me for details about my tax residency, and I confirm that I live in Switzerland and pay my taxes in Switzerland. So what they will do is that my Swedish bank will report my account to the Swedish authorities, and the Swedish authorities will forward it to the Swiss authorities. And now the Swiss authorities have knowledge about my Swedish account. And if I didn't, let's say, disclose this information in my tax return, I might be in trouble, right? So the authorities now know information that they would otherwise not have known. And this is quite a, yeah, the simple way to explain it, right? Under FATCA, it's similar. Let's say I was a US person. I'm not, but let's say I have a bank account with my Swiss bank, with my Swedish bank. I have told them that I'm a US person. So what my Swedish bank will do is that it will report information to the Swedish authorities, and they will forward it to the US authorities, or in case of Switzerland, an IGA2 jurisdiction, my Swiss bank will report me directly to the IRS. And so IRS will know that Emily has an account with a Swiss and or Swedish bank, and they will match it with my US tax return. So you see, very similar. What's being disclosed under FATCA CRS. It depends a little bit on the schema, etc. But typically, it's the name, the address, tax residence, of course, date of birth, TIN, tax identification number of the account holder, the name and other details from the reporting FI, account number, and of course the juicy part, the account balance and the gross payments. Under, well, let's say during the relevant reporting periods. So for example, the balance of my bank account at the end of the year, and also any interest, dividends, capital gains, etc., earned on that account if it was, for example, a portfolio account. And now the authorities have all of this information and they can match it with the details they have from me for my tax return, and they can check that everything is in order. They have the instruments to ask questions if they see that there's a big discrepancy. And here it might be important to remember that especially under CRS, it's a system that does not fit all tax systems. So it means that, for example, there are many countries that have no wealth taxation. And that means that, for example, the bank account balance is actually not relevant in such countries. So sometimes the authorities have more information than they would maybe need to assess the tax return. So there may, of course, be questions where it's, let's say, there are discrepancies, or the tax authorities all of a sudden realize that somebody has a huge wealth abroad, and since they never had to disclose their wealth to the tax authorities because there's no wealth tax, that was not clear. Reports may, of course, raise questions also when there's nothing wrong, just because the tax authorities see something they didn't know before. The compliance requirements under FATCA and CRS, to cut it very short, an entity needs to classify itself either to establish that it's an FI and has own due diligence and reporting obligations. Could also be that it's an active or passive NFE, and then insofar it has a bank account or an account with another FI, it at least needs to disclose its status to that FI. As an FI, you might be obliged to register with the local tax authorities and or with the IRS. For FATCA, maybe you need to appoint a sponsor or a responsible officer. When it comes to registration, it's very different from jurisdiction to jurisdiction. In many jurisdictions, all FIs have to register at a portal. In some jurisdictions, FIs only need to register if they have something to report. So you need to keep check on what's relevant in the jurisdiction you are in or the FI is in. Annual reporting as a basic principle. Also here, obviously, if an FI has something to report, it has to report it. This is clear. Then in many jurisdictions, FIs that have no reportable accounts also need to disclose this fact by filing a nil return. But this is not required in all jurisdictions, so it will depend again on where you're at. Of course, for FIs, you also need to take care of your due diligence. This means, for example, collecting self-certifications of your account holders and or controlling persons of account holders. Each FI should have policies and procedures in place on how to deal with due diligence, reporting, how to cure errors if they are detected, etc. In many jurisdictions, or well, many, but in some jurisdiction, they are even legally required to have written policies and procedures. This is, for example, true for the BVI, where it's explicitly said that written policies and procedures need to be in place. Here we have experienced clients who even got requests from the BVI authorities to provide these written policies and procedures to the authorities to basically prove that they do have them in place. As from this year, Cayman companies will have to file a compliance form with the authorities covering 19 and 20. This is also a way to basically prove to the authorities that you have everything in order. In Switzerland, we have, for example, firsthand had experience of being audited by the Swiss tax authorities. And here it's, of course, very important to show not only that you have been doing the right thing, but why, based on what have you filed your reports, or based on what information have you decided that something is not reporting relevant. And then you, of course, need to show your documentation, your audit trail, show that you have all of the documentation in place, but also that you have sound policies and procedures, that you have the, let's say, the sufficient personnel and resources to carry out this work, etc. So this is really important. And also ongoing monitoring. So of course, you first classify the entity and you file the forms to the bank, or you file your annual returns, but how do you make sure that the classification is still valid year after year? Do you have systems in place to detect any changes in circumstances, etc., in a more automated way, so that not everything is done manually, etc.? Of course, it needs to be in proportion to the size of a business. So it's different if you're a big bank or if you're a small family office, but in proportion to your client group, you need to have something in place to show for it, right? So here we go. And when we talk about due diligence, we wanted to make an extra little notice. The OECD has been taking some action against the citizenship by investment or residence by investment schemes. You have surely heard about such schemes. So a person could, for example, either gain citizenship or at least residence permit in a country against an investment in that country. So for example, if you buy real estate for X 100,000 euros, then you get a permanent residency in this country. Um, these schemes have been used maybe for some people to, let's say, get a better passport where it's easier to travel without having to apply for visas. If you, for example, could get your hands on an EU residence permit or an EU passport, that makes it easier for you to travel around the world. Some people have also misused it to basically build up a, let's say, a fake tax residency. In some of these cases, the requirements for actual physical presence in these jurisdictions is quite set quite low. So it might be that you only have to be there, well, relatively few days in a year, and then it could be questioned if it's really a legitimate tax residency, right? So when an FI is collecting due diligence information and validating self-certifications, they might, in some cases, have to ask additional questions when it comes to, well, if they maybe suspect that a client has taken part of such a scheme. And then it could be, for example, that you ask, let's say if you have a client that is born in a completely different part of the world, and all of a sudden they show up with a Turks and Caicos passport, and you have no record that they have been there before, or that they're born there, that they have family there, business, anything, then maybe the FI will have to ask if this client has been part of such a scheme, how much time they spend in this jurisdiction, etc., and might have to, let's see if they accept this. So this is important for FIs to be aware of, at least, that some extra scrutiny might be sought after in these cases. Good. So we try to summarize in each chapter a little bit what are the main challenges for the industry. Of course, we see it most of all from the fiduciary industry. There are extremely high compliance costs, not only for us, I mean, for the banks, for the authorities, for everybody. This is something to think about because you need a lot of resources to keep everything rolling. You, of course, needs to monitor updates and changes in different jurisdictions. So if you, for example, if you're a fiduciary firm and you have companies and trusts and foundation in many different jurisdictions, it makes it trickier because you need to keep check on 5 or 20 different jurisdictions, whereas a bank, for example, only need to think about their own. A Swiss bank only need to think about the Swiss rules. So this is, I think, a big challenge for the fiduciary industry. Again, going back to the due diligence and policies and procedures, documentation and audit trail is really key, right? Maybe it's not a challenge. Well, for some it is. And also when it comes to the reporting portal, the level of technical unsophistication we put in in clamor, because sometimes the portals are not very sophisticated. Sometimes they are not accessible all year round, or not even a couple of weeks before the reporting deadlines. Sometimes you file returns, but you cannot get a positive confirmation until a couple of weeks later, etc. So sometimes it's really banal, but small technical issues that makes the whole process very, very cumbersome. And I think that will wrap up the FATCA CRS chapter. I will now hand over to Leah Stühlinger, my colleague from the regulatory team. So I will also give Leah access to the screen so that she can control the presentation herself. So, and Leah will speak more about the mandatory disclosure rules. Thank you, Leah.
Thank you, Emily, and good morning to everyone. Yeah, exactly. I will jump to the mandatory disclosure rules and in particular to DAC 6, the latest reporting regime. Yeah, it's working, perfect. The OECD published the Model Mandatory Disclosure Rules, short MDR, in 2018, and they are built based on the best practice recommendations of the BEPS Action 12 report. MDRs are designed to catch arrangements that circumvent CRS, so-called CRS avoidance arrangements. Such arrangements circumvent CRS as it was implemented in the relevant domestic laws. This could, for example, be done by falsely classifying an entity as active NFE instead of PNFE or FI, or also by setting up a structure in a non-participating CRS jurisdiction to avoid reporting thereby, or by using fake tax residencies, as was just mentioned by Emily. MDR also covers structures that disguise the beneficial owners of assets held offshore. These are the so-called opaque offshore structures. And such arrangements usually involve the setup of a passive entity in a jurisdiction other than the jurisdiction of tax residence of the beneficial owner of the entity. And such arrangement usually has the effect of disguising the identity of the beneficial owners. This could, for example, be done by the use of a nominee shareholder, or also by the use of a jurisdiction with very weak rules for identification of beneficial owners. TAX 6 is the EU directive, which entered into force in 2018 and is the EU's implementation of MDR. In addition to just covering CRS avoidance and the use of opaque structures, TAX 6 aims to catch also potentially aggressive tax planning arrangements with the cross-border element in the EU. This makes it much broader in scope than just the OECD's MDR. Not only the EU has implemented MDR, we've listed some countries on this right bubble which have already implemented MDR or are expected to do so soon. Special attention should be paid to the fact that the UK originally committed to implement TAX 6 even after leaving the EU, but then at the end of 2020, they communicated that they will instead introduce the OECD's MDR. The relevant parties involved in mandatory disclosure rules, and especially in TAX 6, are of course intermediaries. In the case of TAX 6, the EU intermediary, which may have a reporting obligation. This could be a tax advisor, a lawyer, an accountant, or any other person who designs, promotes, or provides assistance in regard to certain tax arrangements or just general arrangements. Taxpayers are involved in this regime, and especially EU taxpayers in the case of TAX 6. They can generally be subject to reporting, and they can also have their own reporting obligation, and is shown just in the next slide. A non-EU intermediary like Canada, Switzerland could also be indirectly affected by TAX 6, especially if such intermediary is designing, promoting, or providing assistance in regard to certain cross-border arrangements for EU taxpayer. The reporting obligation does in such cases pass on to the client. What information is being disclosed on the TAX 6? We've just listed the most relevant aspects or information details, but in some arrangements, more specific information is to be provided in the TAX 6 report. For example, if a standardized product was used. It's generally required to include all involved persons, being the intermediary, the taxpayer, but also any other involved person. The relevant hallmark must be provided, meaning the characteristic or feature of a cross-border arrangement that presents an indication of a potential risk of tax avoidance. The list of hallmarks is included to the TAX 6 directive in the annex, and more specific information is available in the local legislation of the member states. It's further required to add a summary of the content of an arrangement to the DAC 6 report, and it should be mentioned that this is just necessary as far as such information is within a reporting intermediary's knowledge. It's not required to dig deeper here. Finally, also the value of an arrangement, the date of the implementation of an arrangement, and the national legal provisions which are met should be added to the DAC 6 report. And as you can see, the identification information to be provided for the involved persons, the intermediary and the taxpayer, covers more or less the same data, which is also reported under CRS or FATCA. So this should not be something new. I will just really roughly outline the reporting process on the DAC 6. You see it looks similar to the CRS FATCA reporting process, but there are a few differences. Let's say that a Cyprus intermediary sets up a reportable arrangement for a new taxpayer. Let's say Sweden again. This intermediary is then obliged to report this arrangement to the local, meaning the Cyprus tax authority, by filing an XML report. The Cyprus tax authority is then asked to exchange this information with the other EU member states. And you see also that if it's not an EU intermediary who implements the arrangement, the reporting obligation would then shift to the EU taxpayer, in this case, the Swedish taxpayer, who would have a subsidiary reporting obligation to report the arrangement in Sweden. The compliance requirements on the DAC 6 are currently consisting in the timely identification of a reportable cross-border arrangement. And it's furthermore required to do the retrospective reporting and the rolling reporting. The first reports for reportable arrangements implemented in this retrospective reporting period, meaning between June 2018 and June 2020, were originally due by the end of August 2020. This is the retrospective reporting. And any reportable arrangement implemented on or after the 1st of July 2020 would have been due for reporting within 30 days. This is the rolling reporting. But due to COVID-19, most EU member states decided to apply a 6-month deferral, deadline deferral, which means that basically reporting started in the last month or even weeks in many jurisdictions and not last year. More specific compliance requirements are, of course, defined in the national legislations of the member states. DAC 6 poses new challenges, especially to our industry. And the biggest challenge is, in our view, the jurisdictional differences in the implementation of DAC 6, especially as some member states were very late in publishing the relevant guidances. Another challenge are the tight deadlines that have just been mentioned, which are just 30 days. And that's also the big difference to CRS FATCA, where we have an annual reporting. We have a rolling reporting here. And these deadlines force intermediaries to implement processes and procedures which enable them to identify reportable arrangements in time. It's also required to coordinate with other intermediaries if more than one intermediary is involved in an arrangement. This is necessary as each intermediary does have its own reporting obligation, unless it can be proven that another intermediary has already submitted a report for a certain arrangement. This can be done by exchanging the arrangement ID, which is provided by the tax authority after submitting the DAC 6 report. The last point listed here is the aspect of automation. In contrast to CRS and FATCA, it's not, or at least not yet, fully possible to automate the detection of reportable arrangements. It's hence still to be assessed on a case-by-case basis, which is of course very time-consuming and costly for intermediaries. Yeah, with that, I will move on to the next reporting regime, the so-called beneficial owner registers. The Financial Action Task Force has set a global standard to put in place measures which are ensuring that legal persons and arrangements will not be misused for money laundering, but also for terrorist financing purposes. And this should be done by enhancing transparency of such entities. The EU has implemented these measures by enacting the EU Anti-Money Laundering Directive 4, AMLD4. This included the requirement to establish a central register on beneficial ownership of entities. AMLD4 was then followed by AMLD5. This new directive extended the requirement to make the mentioned registers publicly available, and in the case of a trust which needs to be registered, a legitimate interest needs to be demonstrated to receive such access. The last AML directive mentioned here is the AMLD6, whereby the latest updates were inactive, being clarification for certain regulatory details, and the directive also toughens the criminal penalties for non-compliance. Not only the EU has implemented beneficial ownership registers, we have listed countries like the BVI, Channel Islands, Liechtenstein, New Zealand, Panama, but also the UAE, which have just recently or some month ago introduced beneficial owner registers. Who are the relevant parties in beneficial ownership register reporting? On the one hand, these are the entities which are incorporated in jurisdiction with the beneficial owner register. These are companies and partnerships, but in many jurisdictions, also trusts and foundations. On the other hand, beneficial owners themselves are affected by this reporting regime. They will be disclosed in most cases to a central register, which is what I mentioned before, in many jurisdictions also fully or at least partly available to the public. The definition of a beneficial owner and the information to be disclosed is in most jurisdictions which have implemented beneficial ownership registers the same or similar. In the case of a corporate entity, a beneficial owner is defined as any natural person who directly or indirectly owns or controls an entity. And we see that often thresholds are being applied, for example, 25% of the shares held. In the case of a trust, the settlor, the trustee, the protector, the beneficiaries, and any other natural person exercising ultimate control needs to be disclosed to the register. In these cases, and especially in the case of corporate trustees or corporate protectors, we often see that a look-through approach is being applied. The identification information to be disclosed here shown on the right side covers basically all relevant KYC data, which is usually anyway collected when onboarding a new client. In addition to that, the date a person became a beneficial owner needs to be disclosed, and the nature and extent of control. Compliance requirements of beneficial owner registers currently consist in identifying and maintaining the necessary documentation according to the local requirements. And it is furthermore required to disclose the beneficial owner information within the set deadline. The last point refers to the monitoring and updating of relevant changes. Changes must usually be disclosed to the register within 14 to 30 days. I would also like to wrap up this section with the challenges that beneficial owner register pose. I would say there are less challenges than, for example, in regard to DAC 6 or CRS reporting, but there are a few which are worth mentioning here. One of the main challenges are privacy concerns of clients, which are in our view legitimate, as publicly available personal data could interfere with or at least threaten the individual's rights to data protection and privacy. It's therefore essential that you or a service provider only publishes as much data as is legally required and not more. And even though the beneficial owner register legislation is, as mentioned, similar in many cases, it's still challenging, or it could be challenging, to keep track of registers and rules, especially if you're responsible for entities in different jurisdictions worldwide. We furthermore experienced, as in CRS reporting, some technical difficulties in reporting the necessary information, especially in the first month of filing information. For example, when we filed information to the UK Trust Register, it was not possible to file any updates to the existing filings at the beginning, at least. Last but not least, it may also be challenging for some service providers to monitor their client database for updates, which then need to be sent or updated in the register. Yeah, with that, I would like to hand over back to Emily, who will outline the important aspects of economic substance rules.
Thank you, Leah, for that. And I hope you're still awake. We try to do a little bit of switching so you don't have to listen to the same voice for the full 90 minutes. Uh, let's speak a little bit about economic substance requirements. So, the background of the EU or of the economic substance requirements comes heavily from the OECD and the EU. As a part of the BEPS, Base Erosion and Profit Shifting Action number 5, some light has been put on jurisdictions with low or no taxations to, let's say, strengthen the economic substance in these jurisdictions. ESR, economic substance rules or requirements, have been implemented or are being implemented in quite a large number of, so to say, offshore jurisdictions. The big ones, BVI, Cayman, etc., already has it in place in some time. We see some registers that become active as of this year, for example, with filings this year or next year. Uh, but yeah, Isle of Man, you have Jersey and Guernsey since some time, the UAE, etc. So it's a big number of jurisdictions. The rules are very similar in these jurisdictions. There are most of the time, in our experience, slight differences in definitions. For example, if an entity is called a legal entity or a relevant entity or a required entity, but the rule sets are relatively similar. So if we look at the relevant parties, it's of course the legal entities incorporated in these jurisdictions that will have to, that will be in scope of the ESR if exceptions do not apply. And in many cases, local representatives, for example, in most of the jurisdictions we have seen so far, of course, let's say the obligation to file correct information lies with the directors of the company, as with everything. But in most of the jurisdictions, the registered agent will be the one filing the declaration with the authorities, and the registered agent and the directors doesn't always have to be the same party. So there's a certain administration or coordination required. Um, I actually chose not to list all of the relevant activities, but relevant activities could, for example, be financing or leasing business, holding business as most common in, let's say, in our line of business, in our experience, but it could also be headquarter business, shipping business, etc. So there's a list of set relevant activities. And if an entity conducts such relevant activity, it also needs to fulfill certain economic substance requirements in that jurisdiction. And again, here we talk about proportionality. So it means that depending on the type of relevant activity and also the extent of the relevant activity, you need to have sufficient, for example, personnel, premises, costs, income, etc. And this needs to be carried out in the jurisdictions. So what will be reported to the authorities is the type of relevant activity you are or the entity is conducting, if any, or if it's not. In most jurisdictions, the company is still required to basically confirm that they are not carrying out any relevant activity. Now, assume that there is a relevant activity, then you also have to then disclose what the relevant core income generating activities are, SIGA, that's short in most jurisdictions, the amount and the type of expenses incurred, the premises held, etc., that you have in place to carry out your business, and the number of employees and resources. And then, of course, if you say, for example, that the only thing you do is that you have one loan, so you're in the scope of financing business, but there's not much activity going on around this one loan, then maybe you don't need to have huge business premises and 5 employees. But if you're a headquarters business and you're really the headquarter of a group and there's lots of activity, you would be expected to have quite some personnel, some premises, costs for that, etc. So it will really depend on the type and the extent of the relevant activity. Uh, what companies will need to do is, of course, assess these requirements. So basically, first assess whether a company is in scope in the sense of, is it in scope of the legislation to start with? For example, it could be that a company is not tax resident in the jurisdiction where it's incorporated. Then it would have to prove why it's not, or that it is not, and that is not in scope. But otherwise, most of the time, a company is in scope if it's incorporated in that jurisdiction. Then they have to assess the relevant activity, whether one is carried out, one or more is carried out. Um, File an annual declaration is required in most countries, if not all, to the relevant authorities, whether or not you're carrying out a relevant activity. And then, of course, if a relevant activity is carried out and you have certain substance requirements to fulfill, you also need to make sure that you maintain sufficient economic substance so that you can, with a good conscience, file your annual declaration. Of course, if it would be found that a company is, for example, let's say in the beginning, not yet fulfilling the requirements, maybe it will have to say that it is taking the necessary measures, and then it needs to also make sure that it takes the necessary measures within a reasonable time. And yeah, these are the key aspects of these regimes in that sense. When it comes to the challenges, in our experience, it's a relatively high administrative burden for the registered agents, for the companies, for fiduciaries to assess all of their entities. The assessment as such doesn't have to be very challenging because it's quite a limited scope, but there's a lot of paperwork. If you work with, for example, different registered agents, it might be that different registered agents have really different requirements of what they will require from the company. Um, so this might be the more, let's say, the administrative burden as such. Of course, you need to carry out the analysis, and that takes some manpower. And since you have to do it every year, you need to have a team ready to have a look at this and make sure that your assessment is still valid, or if something changed, that you will update your declaration. And again, that it is the annual declaration, meaning that it's not a one-off reporting, or it's not a reporting where you only have to report if something changes, and otherwise it will remain. So it's an annual exercise. And I think that with time, many industry players will have to automate the process as much as possible. Of course, there is some need for manual work, but you really need to try to automate as much as possible in order to make sure that you do not miss a filing, and that you don't have to redo the work and start from scratch every year. That, I think, was the shortest and sweetest chapter of this presentation. Yeah, I will do now so that I will hand over to Christian Luc, again, our CEO, FATCA Responsible Officer, and Christian will look into his crystal ball and see what is next.
Thank you, Emily. Warm welcome from my side. Crystal ball is one thing, so we will go through some of crystal ball thinking, but also discuss a couple of trends. And there are also things which will very likely happen, and there are things which will certainly happen, but we don't know when. Let us start with the first slide you see here, just to remind you, and the first forecast I make is not really a risky bet. It will very likely be like that. All this transparency issue you see here on the slide, which will pile up over the day, they won't go away. So this forecast we can certainly do, and it's also clear that more schemes and more of these transparency rules will get into or enter into force over the time. Here you see it started in 2010, but effectively it started way before. Let's say the not so young among us remember back in the 80s when the first exchange of information came on AML issue. And Emily and Leah has shown you where we stand today. If we go to the next slide, you see here a balance. Maybe Emily, yeah. You see here a balance. I think in our view, it's clear that it has added tax transparency, and at the beginning, it's fair to say that all these schemes have created a more level playing field. We had additional revenues identified, and international cooperation has enhanced, and also AML rules have been changed. But we don't have to forget, and my two colleagues mentioned that, at a very high cost. And this balance will probably, this is the second forecast, which is not a risky bet, show different in a couple of years. So the burden of the costs will outweigh the tax transparency benefits by far. That's also something which is pretty clear to us. Let's go through now the different schemes and have a look where we will be. Let's start with CRS here. I mean, CRS, as Emily showed, was introduced a couple of years ago, and at the beginning, mainly the first world did participate. We had the early adopters, we had the late adopters, and only recently, when you mentioned or remember the world card, more developing countries joined the club. We expect that this development will go on from, as I said, originally a system where malicious tongues told that only the rich countries exchange information they already had, to a more global system, which will include maybe one day even the the USA. A second big question mark on CRS is, of course, China. What will happen there? And some developing countries in Central Asia and Africa. We will see in which direction it goes, but the trend is certainly to become more global. On the other hand, it's also to say if we discuss a global standard, CRS is not really a global standard. It has its particularities from country to country, and we see, unfortunately, that the differences in the implementation of FATCA don't become smaller, but they become bigger in many rules. The OECD is trying to tighten the rules and to become the rules more consistent in a way, but I think this is a lost battle. So we will see more differences in the implementation between the countries, but CRS will remain. The question mark around FATCA, I think here we can ask ourselves 4 questions or see 4 trends. First of all, Emily has mentioned it, we have an IGA2 system in Switzerland. That's a Swiss perspective now. I take Switzerland has announced intention to change from Model 2 to IGA1. This was already back in 2014, so literally 1 year after they signed the IGA2. We all remember why we signed this IGA2. It was a bank secrecy issue. But in the meantime, we have found out that an IGA1 would probably be easier to handle. So it's very likely that this change will happen, but we don't know when. This would then also trigger quite a bureaucratic exercise, a one-off exercise on the classification of FFIs and the like. So we will see, don't ask me when, but we will probably see this change from IGA2 to IGA1. Then the question, you can read it in the press and in the news always, the Americans are not really happy with FATCA either. This already started in the late Obama administration. Obama introduced FATCA in the HIRE Act, but they found out it has brought some revenues, but it's also very expensive to run it. And of course, the Americans did it smart because they exported a lot of the costs to implement it, because as described, all the foreign banks and foreign FFIs had to bear the most of the costs. But also for the US, it's not to be underestimated, it costs a lot. We think it's unlikely that the US will cancel FATCA unilaterally without having a substitution. What could the substitution be? Now, we have seen the Corporate Transparency Act 219, which passed the House and the 2 chambers actually in the US. Which will oblige, or should at least oblige, the US entities to collect BO information. To a larger extent, they do it today. And if this is fully implemented, I think the US could be in a position to join CRS, because the information would be available. I don't know, honestly, if this will happen, but at least it's the latest developments show a trend in that direction. So if FATCA goes away, probably substituted by CRS, but it's probably fair to say that there's a long way to go till we will see that. There are also other trends. A lawyer colleague of us, Filippo Nozeda of Michigan de Rea, for instance, and others have filed, has went to court, and there are some court cases going on to fight against FATCA. There it goes primarily regarding these accidental Americans. These are people who have been born in the USA, but then never lived there and have no US sourced income and no links to the US whatsoever. But due to the rules, because they have been born there, they have to file and are affected by FATCA. And we will see how the EU courts will decide on that. This could lead to that less people are affected from FATCA, in particular these accidental Americans, which would then narrow down the scope of FATCA, which probably would not lead that it will go away, but it would certainly also weaken the whole scheme and maybe be another little step towards an implementation of CRS. We will be, but so the next year, that's the bad news. You will certainly have to live with FATCA and its particularities. MDR, here Lea has showed you that not only the EU with DAC 6 has implemented it, but also other jurisdictions from Norway to Mexico. Let's see. We expect there that MDR will be introduced in other financial centers as well. It's relatively silent if you look at the developments in Switzerland or Singapore or other financial centers. You don't hear much. It seems that MDR, from a financial center point of view or from a private wealth point of view, has lost a bit steam. It's also our experience that many of the affected clients are rather in the corporate world than in the private world. So we will see, but it's likely that the OECD will push forward and other financial centers will introduce their MDR, probably or very likely restricted to what it is originally, to the avoidance of CRS schemes, so the hallmarks D. We also saw in the UK, when UK left the EU with Brexit, they immediately gave up DAC 6 and limited it to the original scope of the MDR. In the EU, I think the direction goes, or the trend goes in a different direction. DAC 6 is a bureaucratic monster. One cannot tell it differently. It's very complex. It doesn't add much revenue for the EU states, but it adds much cost. So the whole story comes at the utterly ridiculous cost. But the EU has already announced a DAC 7. It has announced even a DAC 8. So DAC 7, the plans are about new transparency rules on digital platforms. This goes in line with the developments we see on the OECD. You may have heard about this Pillar 1 and Pillar 2 discussions. I come to that under the last bullet point. And DAC 8, that's the plan of exchange of information on crypto assets. That's also at the dawn. We will then see in which direction this goes, but that's clearly the trend in the EU. Whether the EU should in its own food, we will see. Very likely it is the case if you see the developments in Asia and the United States. The EU likes to be an early adopter and the one who makes it most complex. Whether this pay off, we shall see. On the BO registers, here Lea has told you what where we stand. The trend here is also more of the same. So you see the discussions, this BO registers. That's a kind of a hunger and appetite to know more, to install public eyes, which these public eyes don't really fulfill the purpose they are introduced. It's very clear. I mean, those who have nothing to hide will follow the rules and take the cost and the burden, and those who have something to hide, of course, never registered in this BO register and will not register in the future. So we know from experience this BO register can even have negative consequences. look to the UK, where they have a public register since quite a while. And the problem with these public registers, if they are not maintained carefully and diligently, the likelihood that you see accidents is pretty high. We saw that in the UK, where a company was entered with two or with a slightly different name it had, and then was attacked and went bankrupt, and nobody discovered this mistake. And so it's here the benefit is rather small. The risks and the costs are rather high, but unfortunately, currently the trend is clearly to more what they call transparency, and so we will see more BO registers coming. Economic substance here, this again comes to the back of BEPS. Here also the trend clearly goes in a direction where the substance rules, whatever we understand under substance rules, will increase. In particularly, we talk here about economic substance. So really that business is done where the company is registered, and that you need also the tools and the people to do this, to perform these tasks in this specific country. This will go on, which will mean in essence that the structures and the whole group structures will become more expensive, because it doesn't change the fundamentals. We as old tax lawyers know, or those who are elderly tax lawyers like I am know, the good old days where at the beginning of the PE, the permanent establishment discussion, if you wanted to have a PE, you could create a PE, and if you didn't want to have a PE, you had no PE, and the same is still true with substance. It's just much more expensive. On the new scheme side, just one final word to the developments around this Pillar 1 and Pillar 2. If it comes to the taxation of digital firms, you remember that's one of the initiatives in the OECD, or one of the discussions. The old tax system, of course, is probably not up to date and fit to tax the digital giants. And so the discussion started how to catch the Microsofts and Googles and Facebooks and Amazons of this world. They're doing business all over the world, but of course don't pay taxes in many cases where they do business. And so the discussion started. Now we see that the goalposts have been shifted in the meantime. So on this Pillar 1, it's not only about digital firms. The new phrasing is consumer-facing business, whatever this means, and the Pillar 2 is about a minimum tax rate, the introduction of a global minimum tax rate in the OECD. Mrs. Yellen has brought the 21% to the discussion from a US point of view. Others think it should rather be 12%, like the Irish. We will see where we will land. Here, my comment is just if you go back in history and look from experience, tax rates don't mean much, because the question is always the same: 25% of what, or 15% of what, or 12% of what? Without a consolidated and common tax base, the discussion around tax rates is a very academic one, and this has proved to be the major difficulty, if you so to speak, this common tax base, because this goes very far into the national tax system. You remember this EU exercise back started in the early 2000s, the CCCTB, this common corporate consolidated tax base. It's still not in force, and so it's 20 years later. So that's I think, the biggest hurdle, and it will be interesting to see if the OECD proposal also includes such a consolidated common tax base and how it will look like. Because if they limit it to a tax rate discussion, it will lead nowhere. But we will see. With that, I hand back to Emily, and I think she is ready to take questions. Thank you very much.
Yes, thank you very much, Christian. So exactly, I was thinking we wrap up with a small Q&A session. Maybe you made some notes throughout the presentation. So now, if you want to, you can unmute yourself and ask any questions, and we will try to answer them. Cannot give any advice, of course, but at least general. And I got one question in the chat. Will this presentation be sent to us? Yes, we're happy to dispatch the PDF copy of the presentation, so you have it. For your memory, you will also have our contact details you will see here. So if there's anything you wonder, or if you have feedback, you can also send it to me and I'm happy to address it. So yes, now for the Q&A.
Hello, my name is Lucas Stefan, GVO Asset Management. My question goes to Christian. Christian, good morning. Nice to see you. A question, very interesting, I think. The OECD will publish new rules, right? It will be about tax base and minimum tax. Maybe we can forget about any substance rules afterwards. Not necessary anymore. You don't know in which direction it goes. I heard that especially the federal government in Switzerland has also established a working group about minimum taxation. So, what's your personal opinion there? Do we go? Do we have the blueprint from the first tax crisis in the late 2000 with the blacklist, gray list, and then let's say every single country has to take over these rules, and with the pressure of the US as well, we will more or less come to an end of this kind of tax saving structure we had in the past, as we had it with the banking secrecy.
Well, it's a good question. The short answer is I don't know. I think if we look at the past developments, we have seen, on one hand, there's one aspect on this tax race. We have seen a race to the bottom. So over the last 20 years, or maybe 25 years. If you look at historical tax rates, though, I mean, even the 21% of Mrs. Yellen's proposal is historically not a very high tax rate. We had much higher tax rates a couple of decades ago. If I had to bet, I would say yes, there will be probably a range of tax rates, or more than a minimum tax rate. So they will not go to say everybody has to have 15%. They will maybe say, okay, some with some transitionary rules, something between X and Z% is acceptable, because there are big difference between the countries. I mean, if you see a country like Switzerland is totally different to a country like Spain or the US or a developing country, and the conditions are not always the same. So I think it will be hard to find an unanimous agreement in the OECD for one tax rate. We shall see. But of course, I mean, the pressure will go on, and we know the game. In particularly for the zero tax countries, it will be difficult to maintain a zero tax rate. That's my guess. But again, what I mentioned before, it's all about the tax base. It's all about the tax base. Now, the proposal of the OECD says we will start with the large multinationals. So many of the firms at the first stand will not be affected. So you will need to have close to $1 billion turnover or something like that. But it will, I think, trickle down sooner or later. So in short, the answer is I would be surprised if they come very soon to an agreement on one tax rate. And secondly, I will be even more surprised if they see if we see a consolidated tax base. Maybe, but the trend will go in that direction. But don't ask me when this will happen.
Okay, thank you.
Thank you, Lucas. We got two questions in the chat. First, it's a almost two DAC 6 questions. So how do you define the value of the arrangement under DAC 6 rules? That is also a very good question, and there's no very good answer. This is something we have I'm personally struggled with when you have to either report the value of the arrangement or the value of the tax benefit. And not always you can say that it's exactly 10,000 euros or something like that. And I think that well, it will really depend. In some transactions, it might be that you know exactly that if I carry out this transaction in this manner instead of that manner, I will save exactly X%, and therefore I could basically deduct that and say this is what it's worth. It's worth 20,000. In some cases, I think the valuation will be virtually impossible, or probably you could apply different principles. And here I think each intermediary, depending on the type of arrangement, will have to find, let's say, a defendable rule to value an arrangement. And I don't think that it will come down to the euro and penny. I think it will really be if it's around this amount, so give an indication. But yeah, I'm afraid I cannot give much more input on that one. Then we got a question on the bio register and also DAC 6. So I will start with the DAC 6 part since we're already on DAC 6. In relation to DAC 6, we mentioned that Switzerland is relatively silent, and how, from our experience, does DAC 6 impact intermediaries in Switzerland currently? So yes, well, DAC 6, probably Switzerland will never take part of DAC 6 because it's EU, but I mean, I think it's only a question of time before Switzerland will introduce some kind of MDR, mandatory disclosure rules, at least for CRS avoidance and for opaque structures. And for EU intermediaries, let's say, for example, us as a fiduciary firm based in Switzerland, to the extent that we have clients with EU Nexus, we are indirectly affected, right? So we, for example, Kenders Limited in Zurich, Switzerland, does not have a reporting obligation. But if we know that we assist a client in implementing an arrangement, and that means that since we are not reporting, the client has to report, we see it as a client service that we inform the client that we believe that you will have something to report, and we will help our clients to prepare and file such reports if they require so, because we cannot expect that our clients are DAC 6 and tax experts, or that they know how to file the return, etc. So in that sense, I think for non-EU intermediaries with a client base with a EU Nexus, you need to at least make DAC 6 considerations for the sake of your clients. Then our view on the bio registers and GDPR. And here I will admit I'm not a GDPR specialist. We have other colleagues within the firm who are much better with that. But I don't see a conflict in that sense spontaneously, because the bio register is something you have to, let's say, fulfill towards the authorities. It's a legal requirements. So I don't see a conflict between the bio registers and the GDPR as such. But of course, as mentioned, bio register, especially the publicly available ones, I do see the privacy issues in that sense, that not everybody might want to be disclosed, not because they have something to hide, but because they may be afraid that they will be, their children will be kidnapped, or that they will be, let's say, scrutinized in the media, etc. So I think that's rather the issue here.
I mean, we will see ongoing discussion in this field. As Emily said, the more private the information is, then the more discussions we will have, and of course it's kind of conflict of interest, and you see basically to say it I know massively generalized, we see in many systems where corporates have to fulfill or disclose beneficial ownership of shareholders, for instance, above a certain threshold. This is largely seen in line with data protection law. It gets more, the question becomes more relevant and more difficult if it goes to the more private information and the public register. And you might have heard about a decision of the French Constitutional Court, I think some 2 years ago. The discussion, the French wanted to introduce a public register for trusts. And then an American lady living since a long time in France brought the case in front of the French Constitutional Court, and she did win the case. So the French Constitutional Court said, look, your estate planning, there's no benefit or no justification then private estate planning has to be in a public register. And so they forbid to France to introduce in such cases a public trust register. So this is only a court decision, but it shows that this battleground between legitimate privacy protections and rights and the public eye and is going on, and there will be many more court cases. So, but I think there's somewhere a line which is drawn, and even if maybe it's a blurred line in some countries, which will stop it. At least this is my hope.
Excellent. Any further questions? I guess you're hungry. We still have 7 minutes. So if you have any more questions, write them in the chat or just unmute yourself and speak up. No, I think the hunger is speaking. So we will not keep you longer than necessary. You might also have, of course, questions that you would like to address directly to us. Then again, in the presentation, which we will send out to you probably this afternoon, you have our contact details, email addresses, phone numbers. Please do not hesitate to contact me. I suggest you go through me, and if I need to involve anybody else, I'm happy to do so. And then we would also be very thankful, of course, for your feedback. So if you say a specific topic is extra interesting to you, may it be DAC6 or other matters, then we would be really thankful for such feedback, and then we can see which direction we will go for the next webinar. Because as mentioned at the beginning, our idea is that we start really broad with this one today, covering many topics, and then we try to make it more specific. So for example, we can do an in-depth CRS or an in-depth DAC6, depending on what you think. And I would like to thank all of you for, again, taking the time to listen to us. Thank you for participating. Thank you for good questions. And I hope to see many of you again. I hope to get the chance to speak to many of you. And thank you, Christian and Leah, for supporting me today.
Thank you. Goodbye, everybody.
Bye. Thanks a lot.